Hello everyone and welcome back to another episode of the Smart Money Show. I'm one of your co-hosts, Ali Suleiman, and the only co-host on this episode. Unfortunately, I'm not joined across my table by my co-host and co-founder, Naman Akhtar. He's extremely busy, understandably, at this current moment in time, but we are back with another episode, and it is the June plus July economic recap episode. We did miss one. There's been internships flying about, conflicting schedules, but we have managed to sit down and actually get a recap episode together for today. So as usual, I am joined by Dylan Ilett, our Head of Equities at the Smart Money Show. It feels like it's been a while, Dylan, but how are you?
Yeah, very good, thank you. Just halfway through my internship now, so I've got a few more weeks left. So obviously it's been quite busy, which is why it's been a slight struggle to get our episode filmed, but been gaining a lot of experience, and it's great to be in a workplace where you're surrounded by all concepts in global markets and private markets. So it's been a really enjoyable experience.
For sure. And I'm looking forward to seeing some of that expertise trickle down into the show and into some of these episodes as well. And for our loyal listeners, sometimes, all the time, we're joined by our head of crypto, Jeremy Okorno. But unfortunately, this will be our first episode where we're not joined by him, and it will be like that for the foreseeable future. Jeremy's been super busy and he's got his fingers in so many different pies, and so unfortunately he has had to take a step back from the show. We always loved having Jeremy on. Of course, Dylan and Jeremy were part of the founding team of the show, being with us since before our rebrand all those months ago, back near kind of March, April time of last year. But he will be taking a step back, and so me and Naman thought it's time for a change, it's time for a pivot. And because our show is all about helping students like ourselves break into those elite financial service roles, we thought maybe it's time for crypto to take a back seat. And we thought it's time to launch a new team, employ a new head, and get a new face onto the recap episode. So very excited to announce the launch of our brand new team, Fixed Income, Currency and Commodities, or FICC, that's how it's referred to in those sort of elite financial service firms. And our new head of FICC is a very close friend of mine, someone who I interned with at UBS at Spring in my first year, and we've stayed in very close contact ever since. A very, very close friend of mine. I say we train together. He trains and I watch at the gym together sometimes, but very privileged to welcome Wahy Yahya onto the podcast. Wahy, it's been long overdue, a long time coming, but how are you, and welcome to the show?
Well, I'm good, thanks. Thanks for having me as well. Very happy to be a part of the team. Yeah, it's a huge leap that we've just taken. Created a whole new team.
Yeah.
Yeah, got my own analysts as well. So a lot of coverage will definitely be putting out.
For sure, 100%. And before we really get into this, in the interest of time, as Wahy mentioned there, analysts, we have launched our website, our brand new online HQ a couple of weeks back, and you're seeing at least 2 or 3 articles, student-led journalism, student-led reporting, news reporting being published onto that website, led of course by our heads as well, including those crypto articles. So it might have taken a backseat on the podcast, but it's still being covered in that written format. So of course, this is an economic recap episode, and for those, it has been a while. For those who don't know how it goes, we always start with a bit of macroeconomic data for the US and the UK, and then we get onto some niche news, which for this episode and for the foreseeable episodes will be some niche news in equities and some niche news in fixed income, currency and commodities. So what we're covering today, we're going to kick off with some US and UK economic data. Then we're going to get into some bank earnings, some Goldman and Bank of America warning for US stocks, as well as, of course, I feel like every episode is going to be like this, some updates from Trump. And of course, we're going to get into a little bit of fixed stuff, including deal flow, profit trends, curve dynamics, credit spreads, and everything else in between. So very excited to get into this alone hosting. I feel like I get the podcast and the episode to myself for once, although Naman might not be happy to hear that from me. But let's get into it, to be honest. So Dylan, why don't we kick off with you? We're going to kick off with some US economic data. So what's the big picture coming out of the last couple of months, coming out of June and July, going into August?
Yeah, so I wanted to start actually with some data that was released a couple of weeks back, and it's concerning tariff revenues. So the US have actually reported for the 2025 fiscal year so far $200 billion in tariff revenues, and that's expecting to reach $300 billion by the end of the year. So of course, obviously, there's this commotion about tariffs and how it's affecting economic growth, and is it going to spike inflation? But in my opinion, a tariff revenue of $200 billion is quite substantial. And obviously, that's going to impact GDP growth. And obviously, it's a relatively decent sign for the US from that front. And we've seen some wage growth as well. So, for example, blue collar workers, their wage growth increased by 2% over the past couple of months, which again is relatively good signs for the US economy. So, sort of taking a step back. So, the last readings that we had for GDP, the US economy actually contracted by 50 basis points /0.5%. But we've just received the new readings for GDP growth in the US, and it's came in at 3%. And obviously, of course, there's a lot of concerns about the US economy and what direction are we heading in terms of inflation, interest rates remaining high. Is the economy going to further contract with less trade deals on the table? But it seems like the US economy, as always, I mean, it's almost like we repeat ourselves every single podcast, is remaining resilient. And that's actually led Trump to sort of take another hit out on Powell and effectively say it's time to cut rates because now GDP is rising. And also we saw another piece of data from the US in terms of inflation, and it's actually up from April. It's at 2.7% in May. So again, it's good signs for the US economy, but obviously with inflation rising, it seems that now tariffs are sort of having to have that knock-on effect that they didn't before, because obviously we know when tariffs were first announced, we saw a lot of corporate companies sort of importing the goods early before the tariffs came into play. But it seems like a mix between energy prices and also tariffs are starting to sort of reflect the outlook of the US economy. So we've got strong GDP growth. However, we've got inflation on the other side of things slightly rising. And Trump, as we'll be talking about later on in the episode, he's putting some pressure on Powell.
Yeah, for sure. And the kind of the lack of camaraderie between them has been quite funny. I think this past couple of weeks, like when they were literally standing in front of press and Trump was like, this has changed, and then passed the paper over to Powell. It was like a sketch. It was just hilarious to see. And I was going to ask you about US stocks, but you're right, we're going to cover it as well as covering Trump. So I think it's a perfect time to quickly move on to the UK macro. You can tell I'm excited to get onto the niche news. So Wahy, let's start with the kind of big picture. How has the UK macro story evolved over kind of June, July? And again, same sort of question. What are we looking at going into this new month of August?
Sure. So obviously we've had a pretty weak start going into Q2 compared to Q1, as the UK delivered a 0.7% quarterly growth in Q1, which outperformed G7 peers. Very, very good. However, a few things have happened over the past few months, and just to touch on it really, really quickly, we've got inflation. We know the situation with inflation in the UK. I like to call it a bit sticky, and it actually rose from May going into June. So in May it was 3.4% in CPI. That increased to 3.6% in June. This is mainly driven by transport, fuel, food costs, and it's pretty much been a 16-month sort of high compared to other points in the year. Now we're looking at inflation to peak around 3.7% in September. It's still not good given that the Bank of England's target is at 2%. So what we're looking for is we're looking for some sort of government intervention to come into play. The government needs to do something in order to bring that level down, and there's a host of things that they could do. But we'll get into that a bit later on. Now, when we look at consumer and trade trends, retail spending growth slowed year on year. It's at 0.8% in June, which is down from 2% in May. In terms of UK trade, goods have declined in terms of exports. We've got roughly 5.4% year on year in the last 12 months to around which is around 360 billion, near enough, from May 2025. Which essentially means that our imports have exceeded our exports. So our trade deficit remains persistent. in that regard. And when we look at the banks, we can see that recent growth may lead to a boost in consumer and business confidence. Although this has been falling in recent months, this could lead to a kickstart in growth, as we
Okay.
see a continuation in 2026. We're looking at investment specifically being a potential rise, especially given that the Bank of England has priced in 2 rate cuts going into the end of 2025. But yeah.
Yeah. No, I'm very, very much looking forward. It's why I love these episodes, because at the end of the day, it's like an online diary to see if our predictions were right. So because these are monthly episodes, hopefully if we can get the months going again, we'll be able to actually look back and say, right, we thought this would happen, but this happened instead. Why? And we get to question that. Brilliant. I always love starting off with that. It really paints or provides a frame to the picture we're trying to paint in these episodes. So I'm going to swiftly move on to back to you, Dylan. We're going to go into bank earnings, which, while you talked about banks a little bit, so it was almost like a perfect segue onto that. So we've had another round of earnings. What stood out this quarter?
So it's effectively a replica from Q1.
Yeah.
So for those that listened to the previous episode where we covered bank earnings, we saw revenues rise at almost an incredible level given the economic output and outlook at that time. But we've seen JP Morgan, for example, their revenues have actually risen quite highly, and that's because of their markets division jumping 15%. And we've got the same for Bank of America. They've increased 4% year on year, and their EPS has risen to $0.81. And again, this has been fueled by market growth. We've also seen Barclays, their profits jumped 34%, and that was mainly due to trading activity.
Mental.
And that's led them to announce a share buyback that's worth £1 billion. And, you know, when we look at investment banks, we obviously need to understand they have their asset management division, we have their M&A division / investment banking, and their trading division. And obviously when interest rates are high and there's quite an uncertain outlook on the economy, companies don't normally engage in M&A deal flow. So for these investment banks that have these trading divisions, it's really like a safety net for them, because volatility is their friend. And obviously what we've been seeing in markets over the past year, the S&P was down nearly 7% towards the start of the year, and now it's up nearly 9%. So we're seeing volatility by the day, and that is because we've got someone like President Trump who's extremely active on social media, and we have a big retail presence in markets these days who can effectively just buy and sell based on the sentiment from his tweets. So, you know, this volatility that we're seeing is actually supporting banks, and it's led to a lot of the banks to gain an average of roughly 4% on the days that they have announced their earnings. We've also seen the same for Citigroup. They reported strong revenue growth, mainly from their equities trading division. So as I said, it is stemming from these market movements. So that's what's been happening with banks. And, you know, as we say, the company structure, they're very shielded to perform well in most market conditions. So that's what we've seen from banks in Q2.
Yeah, for sure. And a pretty simple follow-up question. Do you see another repeat in Q3 in your eyes, or is there anything that you think could potentially change that?
I think the only thing that we would see that could change the dominance in the markets divisions for banks is potentially a rate cut. But obviously with inflation rising and Trump and Powell's beef effectively, this is I don't see that as a likely outcome. And I think markets have changed now, and I think this is something that investors need to understand. There's going to be more volatility, and I think investors are bracing that. And I think trading revenues for banks are just going to keep climbing, because, you know, we're heading into a time where volatility is more common than it was 10, 20 years ago. So I think that's a trend that we'll continue to see.
Yeah. Interesting times for sure, but at the end of the day, banks most likely will always win because they've got the most expertise. They've got people like you, Dylan, behind them, right? Right, let's move on to our first niche FICC topic, and nowhere near the last either. We're going to move on to something called clearing volume explosion. Wahy is how you worded it in the topic list. So I know that there's been a huge jump in clearing volumes recently, and I want to ask you a double barrel question. So first of all, for our listeners and viewers that don't know what clearing volume actually means, do like and explain like I'm 10 years old sort of thing. Just kind of do a brief sort of simple explanation of what it is, and then just explain what is driving this explosion. What's driven this spike in clearing volume?
So to explain what clearing volume even is, we need to understand what clearing houses are. So whenever trades are being sent through or being processed, they have to go through a regulatory process, which is through clearing houses, where the trade from execution is then given to the buyer or the seller at given price at given time. And this is done through those clearing houses. Now, when we talk about this explosion that I described it as, the DTCC, which is the Depository Trust and Clearing Corporation, essentially governs all of this. They cleared a record of $11.8 trillion in US treasuries, which is insane. It's absolutely insane. And $2.48 trillion from that is in sponsored service volume. Now, the implication of this in terms of real money is that we're now rotating into more rate stability, which means that obviously, given that we've had, Trump's tariffs and, a lot of these things that's happening in the world right now, we're looking at increasing that explosion, which is why I called it an explosion in the first place. We're looking at that number increasing. And which this essentially means that more trades are now being passed through those clearing houses. Now, although this can scream uncertainty, given that Trump tariffs have also been announced recently, people are looking to offload their risk. They're looking to be a lot more risk off, we'd say in trading terms, since the tariff news has died down a bit. And there could be a scale for repositioning if they believe that the market sentiment is changing. There could also be repricing as well when it comes to the amount of news that's happened this week with regards to interest rate swaps, gilts, and FX hedging. And with volatility, there also comes a lot of changes in prices of rates, FX, and credit risk. So at the end of the day, the team and I at FICC have come together and we've essentially spoken about this, and we do think that given everything that's happened in the news recently, that explosion is here to stay for a while.
Yeah, there was when you said risk off, basically, we just filmed episode 20, which we'll be releasing after this, a couple of weeks after this, and it was with someone who had like 40 years in the field, and he's seen like literally every crisis you can study in the last 4 decades he's seen. And he said a really good analogy, which I think applies here, because he said risk off. There's a storm potentially brewing, right? And he's been through so many storms, and he said that you got to think of leverage as a sail, exposure as a sail. And when there's a storm coming, you want to reduce that sail so you don't basically get washed up. You don't fly away, for lack of a better phrase. So there's a reason, as you said, risk off. There's volatility. Does that mean anything else though for liquidity, for market stability, or just on a broader scale how firms are managing risk? Does it change anything in those regards as well?
Yeah, sure. So when we look at the whole risk-off environment, we're essentially seeing that investors, higher net worth individuals, anyone that's taking on these trades and taking a trade through those clearinghouses, they're moving away from more riskier assets to more safe haven assets. And we'll touch into that as well as we talk about gold, the whole gold setup, which is very interesting as well. But we see that the move going from the more riskier assets to more safe haven assets is essentially like the common trend that you see whenever someone says that they're risk off. So you're gonna see sort of increases in price, increase in demand, consumer demand for especially through clearinghouses of those safe haven assets, commodities. You've got a few in FX, but we'll definitely touch into that a bit later on.
Yeah, no, interesting stuff. And of course, we just released an article on gold, so it'll be interesting to see how your thoughts on that article match up as well. Right, Dylan, let's throw it back to you. And normally when we talk about US macro at the top of the episode, I do ask for your opinions on kind of how equities are reacting, especially specifically US equities. But in the topic list this time, you've put in Goldman Sachs and Bank of America, their warning for US stocks. So they've both issued warnings, but what exactly are they flagging and why?
Yeah, of course. So, I mean, it's been a recurring theme dating back to when we actually started the podcast way back in 2024. Is the US market overvalued? The answer is yes. Um,
Yeah.
will that impact the trends that we're seeing? Probably no. So we have Bank of America and Goldman. They've released a report effectively explaining that they feel as though valuations are stretched in the US market, and obviously we have many tech firms, even many energy firms, the banks. Their price to earnings ratios and their relative valuations are increasing at rates that we've probably seen in the dot-com bubble. And obviously, this is a big comparison that we see across investors. Well, we're at that stage where it's like 1999 again. We've got all the big tech companies with valuations that are way above their current earnings. I have a counter argument to that in the sense that I do believe that we are seeing overvaluations. But as I said to you guys before, the markets have changed, and investors rely on growth a lot more nowadays, and that is what we are seeing, and this is how we're seeing markets stay resilient as they are. And secondly, during the dot-com bubble, the 5 companies that basically entered the US into that bubble and then eventually burst, their actual economic output was very minimal. And we're entering a new age now where AI is being integrated into almost any form of company. For example, my workplace, I work at a restaurant part-time, and we now have an AI bot to take our bookings, right?
No way.
So, yeah. So, AI is being integrated left, right, and center. So when we talk about Nvidia having high valuations or Microsoft having high valuations, they're all integrating AI in some way, and they're trying to come up with products that can serve that market in the future. And obviously, when they have such large cash piles, obviously they've got the monopoly power to do so. So it's one of them conversations where no one knows the answer of how big the AI market will be in 10 years' time. Be colossal in 10 years' time. It can just be a thing of the past, depending on what regulatory impacts there are, and also what we find with AI, and whether if we hit like a brick wall in terms of production. So that's effectively the argument we're seeing, and obviously there's high concentration risk in these US markets. For example, last year the Mag 7 made up roughly 34% of the S&P. In Germany, well, for an example, slightly off topic, but their 10 largest stocks made up over 60% of their respective index. So overvaluations and concentration risk is an issue, and the reason why there is so much concentration risk is the rise of passive investing. Because no matter what, if we have investors now where they are just wanting to put their capital into an index instead of trying to beat the market, because now as a trader, if you're a retail trader, you're receiving information 2 to 3 seconds slower than, for example, someone at a bank or at a large institution that can get that information fast. So what retail investors are trying to do now is just place their money into index funds that are offered by BlackRock or Vanguard. And what this means that no matter what market conditions we're in, if you're a passive investor, effectively you're injecting capital into markets once a month or once a year. So no matter what the news is, with the rise of passive investors, we're seeing inflows into these companies no matter what that make up the index. And that is why the concentration risk has increased so much, because there's always going to be inflows, whether the fundamentals are there. So effectively, this is what Bank of America and Goldman are seeing. Is there a solution to it? I don't quite think so. Markets are staying resilient, and I mean we'll talk about it later on this episode. But markets have changed, and I think it is something to keep in mind. But as long as markets are staying resilient, if you're a bullish investor, ride the wave.
Yeah, what a brilliant answer. And you kind of answered all my follow-up questions as well. But I'm so glad you spoke about overvaluation and AI in the same sentence. Did you see Figma's IPO in the last couple of days? Bro, absolutely insane. So obviously, I'm in the marketing space a little bit. So Figma is like this map. For those who don't know, it's like this breakthrough AI design tool. You can literally create anything in it through a prompt, and it's pretty insane. I believe you can also, they're working on doing websites as well, and it will like create the HTML code. But they IPO'd a couple of days ago, I think, and it was insane. I think they ended up trading at like over 50 times sales, and it surged like 250% on its first day. It was mental, and it was funny. I love talking about Jim Cramer. Bless him. He's such a great guy. But yeah, Jim Cramer, he basically said that it could be a sign of market froth, and it's not a sustainable valuation at all. And it got me thinking. It was like, it's so reminiscent of the dot-com bubble. It's actually, it's almost surreal how reminiscent it is. And the reason why this Figma IPO stood out more to me, obviously knowing what Figma is because they did, Adobe tried to acquire them, I believe. I don't know how long ago it was. And it was for $20 billion. And it didn't work out, and then Figma internally changed their valuation to, I believe, half that. It was about 10 billion. But then they've gone for an IPO, and then now they're valued at triple that. And it's just these valuations being thrown around. But also it's like, if you go to the other side of the coin, I know I'm waffling on a little bit, but it's just so interesting. If you go to the other side of the coin, you could say that there's been money left on the table, because if the stock price jumped that much, maybe they could have priced the IPO higher. I think it ended up being like 69, 70 times sales at the end of the day. It was just mental stuff. So you're right with overvaluation, but markets are changing. But as you said, they're staying resilient and they're adapting. But there's a bit of a market bubble brewing. It has been for the last couple of months. So we just got to see where it's going. But it's interesting times for us anyway. I'm going to move on because that was such a holistic answer, bro. I appreciate it. But let's go to gold setup now, Wahy. You touched on it in your last answer. Gold has been in focus again, as it kind of has been for probably since the start of this year, if not the end of last year, mainly because of geopolitical tensions, of course. So what's the current gold setup in terms of demand and pricing? And just talk us through that.
Yeah, sure. So the team at FICC have recently put out an article whether or not we think gold is overstaying its welcome or we think it's just right.
Yeah.
And the way we've handled it is, it depends on what your take is on the markets currently. And we'll get into that right now. So gold currently, obviously this month has surged 3.5k. We call it the 3,500 handle. But it is still range bound between the 3,280 and the 3,500. And what that means is it's kind of in a consolidation zone at the moment. And we know that gold, which is also like man and Hamza, part of the FICC team, our favorite topic to talk about right now, is because we've studied gold from last year, 2024, October, November, surged and just about hit 3,000s, which was insane. And we actually managed to catch that move whilst it was playing out. So it was really good. But to see gold surge from there, given that it's a traditional safe haven asset, and to see it stuck being range bound, surely it must mean that something else is happening. And it has. We've been seeing that silver and platinum are now being positions that investors are now rotating out to. And in terms of the data we've got silver surging 50%. We've got platinum surging 50% year to date in terms of its growth, which is insane, right? Absolutely insane. And when we look at silver as well, the sort of ratio that we have between silver and gold, because we always like to compare the two since they're very correlated, it's shrunk, and the smaller the ratio is, the better it is in terms of correlation. And so that's gone from 99 to 91. And silver currently trading at around $36 an ounce. It's surged 8.8% alone in June.
Whoa. Yeah.
So we're definitely seeing that smart money. We're talking about institutions, investors. Investors are rotating out of their gold positions and sort of treating silver and platinum themselves as safe havens. Now, the team and I, just to touch on this really quickly, the team and I do think that we're going to stay tactical in this approach, because people are asking, what's our position looking like? Are we going to go long? Are we going to go short? We're going to let it play out for now. We're going to let it stay range bound, because we're looking for some sort of breakout past 3,500. And Goldman Sachs themselves have put out that their target projection is 3,700. So with that institutional backing, we've seen smart money thinking that gold is going to increase in price. We're going to stay tactical, wait for 3,500 to break. However, if it does dip, I am a huge advocate of buying the dip. Huge advocate. Like, I love it. Absolutely. Just if you see a dip,
you and Jeremy, bro.
Yeah, if you see a dip with good enough fundamental backing, then in my opinion, I think that will outweigh your technical indicators. Just because you need to be able to take that risk in markets. You know, I remember Dylan spoke about this in a previous podcast. He himself talks about his equity positions and how he loves to take on that risk. And so I'm a huge advocate of that. So yeah, no, just my point being is that, you know, we're most likely going to look for gold longs. Look at it from like a holistic point of view. We're going to be rotating more into platinum and silver as well.
No, very interesting, and I think it's a perfect time to talk. To just quickly say, obviously, to our listeners and viewers, it's not investment advice. It's just our own opinions. We're just students. Don't invest anything based on what we're saying. Please don't. It is just our own opinions, for sure. No, but very interesting stuff. And the article's a great read. It's a really good read, and I think I just want to maybe quickly ask a follow-up question on what are the other drivers around it. I think it's very easy to say, okay, it's inflation hedging, but is it also like macro risk? Do you think that's the main driver, or is it something else? What is it? Is it something else that's really driven that surge?
Yeah, sure. So central bank reserves have increased and they've surged an insane amount. So they're looking at aggressive buying here. They've exceeded 1,000 trillion, which is, can't comprehend, of 95% of the reserve managers. So it's definitely central bank reserves increasing in terms of their holdings of commodities, gold in particular, in question. And in terms of the demand side, we've seen a huge increase in gold ETFs as well. So the inflows into gold ETFs have also spiked. Retail investment flows have dominated. So in Q1, we saw a total investment of demand for gold surge to about 170% year on year. So yeah, definitely those are the macro drivers. Obviously, in the article, we've also spoken about Powell, inflation. So definitely, if you guys want to have a look at that, check out the article.
Yeah,
it's all on there.
For sure. We'll link it in the description as well because it is really good reading, and there'll be more like that from all the teams, but especially the FICC team as well. Right, Dylan, we went 30 minutes without mentioning Trump, and unfortunately that's the longest we could go without doing it. So there has been fresh news on Trump, as always, as it is every day. You wake up, first thing you're doing is hearing about Trump. So what's the latest, and how are markets interpreting it?
Well, besides cheating on the golf course, he's been quite busy. I'm going to split this up into what's been going on with Powell and also from a tariffs perspective. So there's been an announcement of some new trade deals. So, for example, we've seen a UK and US trade deal, which effectively has set some outlines on automobiles and areas like that. And it's been a bit of a theme in his trade deals because one of the main things that he spoke about in his presidential campaign is he wants to bring car manufacturing back to the US. However, all of his deals that he's cited lowering tariffs on in his agreements he's lowering tariffs on automobiles, which effectively is providing incentive to bring them to the US. Obviously, so he's announced the UK. On the 27th of July, there was talks of a 15% baseline tariff on Europe. And again, the major exemptions that we've seen in this deal are zero tariffs on aircraft, semiconductors, drugs, steel and aluminium, and also automobiles. Again, so all of these deals are tied to a specific investment into the US. So there's a deal with Europe where there has to be a $600 billion investment into the US. Same with Japan. What we've seen is a lowering in tariffs for automobiles, but that is also tied to a $550 billion investment into the US. Now, the big one that everyone talks about is China. And there were talks in Stockholm actually this week about a potential conversation about pushing back the deadline. And obviously, if there weren't any deadline pushbacks, these tariffs would have been put into play months ago. But obviously the deadline keeps getting pushed back. So the 1st of August, which is the day before filming, we were tariffs. And now there's talks of we've pushed them back to the 7th of August, and US and China are in negotiations at the moment about pushing the deadline back to the 12th of August. So there's actually been some commentary from Trump from this perspective. So in our quote, he says that the relationship with China is tough, and he would only agree to a meeting if Xi Jinping formally invited him. So he's playing hard to get with China effectively. And I think what's going to happen is effectively these deadlines are going to keep getting pushed back and getting pushed back and getting pushed back until there's a right deal on the table for both parties. And we know how stubborn US and China can be with each other. However, from a wider global perspective, we have seen Trump reach agreements with the EU, with the UK and Japan, which were some major trading partners. Moving on to So you previously mentioned, Ali, of the fact that they were at the brand new Fed HQ, and Trump quite publicly and purposefully questioned all of Powell's numbers and calculations of how they've worked out the cost for the Fed HQ. So effectively belittling him in front of the entire world. And to be honest, one of the first times we've actually seen them have a face-to-face contact with each other, and it's been publicly aired. Normally what we see is like phone calls that they've had, or Trump's just tweeted about him like a 10-year-old. But that's effectively what's happened. So the only way, so obviously Trump wants Powell out. And obviously there's one argument that Powell has done very well to manage the US economy from a fiscal and monetary perspective. Trump thinks that he's too slow to cut rates, and obviously with the GDP growth, Trump's also hit out on him again. So he's introduced a new method of how he's going to kick Powell out of office, and that is by effectively suing him for mismanagement of the new construction of the Fed HQ. And obviously, we know how unpopular Trump is from a law perspective in terms of his felony charges before his presidential campaign. We know that antitrust actually blocked some of the tariffs that he tried to implement because they weren't classed as an emergency tariff. So it will be interesting to see how this actually goes down, this lawsuit, whether he will implement it. But obviously there's been some commentary as well where Powell might just turn around and say, you know what, I give up. I will leave office and leave it for someone else, because no matter what he does, he's in the limelight for it. So that's basically what's been going on with Trump. He's been busy with tariffs, and he's been busy trying to kick out the head of the Fed, who he actually appointed in his first term.
Yeah. Bro, it just feels like a South Park episode, man. It's just mental, and it's just like day in, day out. But again, I mean, we love seeing markets, and we love what you seeing how news affects it. So it is interesting at the end of the day. I want to kind of put myself in your mindset when it comes to investing. I mean, it was interesting. We don't talk about it enough. It's interesting, Wahy, you talking about how your mindset. So with all this stuff going on, all this, the fact that Trump changes his tune or says something more, even like tweets, when you're investing, how do you separate between what might actually make a difference and what is just noise, but in your mindset when you're actually investing?
I think it goes back to the question of what is the difference between trading and investing. So obviously I class myself as an active investor, but also I do have many passive funds in my portfolio. It's a combination too. So I do engage in stock selection, and I do buy active ETFs and investment trusts. But then also I'd say the baseline of my portfolio are passive investments, and that could be the MSCI World, that could be the S&P 500 equal weight, that could be the FTSE 100 or the FTSE AIM market. But yeah, so coming back to the answer, like obviously from an investment point of view, I'm investing for the long term, and what I typically try to do, and that links to what's been said before, I do try to buy the dip. However, obviously, when you talk about markets from a long-term perspective, I do just try to effectively dollar cost average throughout the year, because I'm not looking to enter a position and then exit it within a month. And obviously, volatility is going to impact you much more from a short-term perspective. In terms of like sectors and regions I'm looking for, I do believe that the US is overvalued. However, I've said before that they are resilient and they are world leaders in what they do. So obviously, of course, there's an allocation to North America, but I think a trend that we're seeing is actually emerging markets. Obviously, we've seen countries like India, their GDP has risen at a very fast rate, and it's continuing to, and that's because they're getting big on technology. Even places like Nigeria, for example, they're trying to become a massive fintech hub in Africa. So I do think sort of paying attention to these areas, and obviously there's a trend towards de-dollarization, and the question of, will the dollar be the common currency for global trade, or will it be overtaken by something else? And I think that's obviously a massive thing that impacts these emerging markets. So for me, I think it's about taking a long-term view. So I don't necessarily worry about what's happening from a short-term perspective, because markets always correct at some point, and over the past 30, 50 years, if you placed your investments into just the general all-world index, you would be much better off than you were if you put it into savings. So obviously there is an active element, but I try to sort of stay away from what's happening short-term and look at the long-term trend maybe over a year time.
Yeah. No, amazing. And I think our listeners, and I did as well, just appreciated just looking into how you actually think about it as well. And de-dollarization, we've got to do a piece on that, a joint piece. It's got to be done. It's just very, very, very interesting stuff, because it's equities and currency, so it could involve both teams. Right, let's swiftly move on to talking about bonds, Wahy. Obviously, you've got quite a big purview with fixed income, currency, and commodities, of course. So you highlighted a topic: curve dynamics and credit spreads. So how have yield curves and these credit spreads, how have they shifted over the past couple of months, and what has stood out for you?
Sure. So speaking of FICC and equities actually collaborating, we had an article this week put out about the fixed income market, specifically looking at curve dynamics and spreads from the equities team. Obviously, I had a look at it as well. Really good article, and I definitely recommend everyone who's listening to go and read that, because it is like gold. See what I did there? Anyway, so what really So IG credit spreads remain near post-COVID lows. The issuance is oversubscribed, with minimal issuance premiums. So the red flag here is that spreads don't reflect inflation or policy lag risks, which means that those decompression trades, they do warrant a caution. So they are a cause of concern. They need to be looked at as well. Now, when we look at yield curves, the UK's tax cuts, coupled with the fact that we have higher spending, as we spoke about earlier on in the macro section, that's now led to an increase in the issuance of long-term gilts. So that's now increasing or putting an upward pressure on demand for those gilt prices, which in turn leads to spending possibly increasing, which could also lead to financial instability rather, as the UK has a higher debt GDP ratio, which may lead to trade premiums being demanded more by investors, but you could also compensate for this added risk by doing that as well. Now, in terms of credit spreads, here we're talking about the fact that the UK economy is growing, but real household incomes are falling. Whilst inflation and public debt are rising, this means that companies are less likely to do well as they have less disposable income, leading to higher credit spreads. You've got and you've got to sort of compensate for that risk default due to a period of economic downturn through those higher risk premiums. Um, just to put it in short, this means that some industries may see tightening of spreads. Uh, Dylan spoke about this earlier. AI, huge thing currently.
Yeah.
So AI and defense has definitely been guaranteed spending by the government, and therefore in those areas there's been less risk. Since we heavily depend on it nowadays, as Dylan said, sorry, in his workplace, you've got
Mm.
AI bots taking orders, so because we're heavily depending on it, the government therefore associates less risk to do with that. But yeah.
Yeah. No, amazing, and it's good to finally cover this in detail on the show. Sometimes we just mention it in passing, so it's good to really delve in. So how, in your opinion, how are investors positioning along the curve right now, especially with those rate cut expectations moving around?
Yeah, so I think this ties back into the idea of, are you a trader or are you an investor? Can you ignore that
Yeah,
noise going on in the background? Because when it comes
yeah,
to fixed income and currencies and commodities for that matter as well, those trades, those short-term trades that you make are based off of that noise. And when we talk about that noise, talking about inflation, as you mentioned in the macro section as well, we've got an increase in volatility in the short term with what's happening in inflation at the moment. But this may, as a result, lead to a flattened yield curve in the long term, as we see, a lack of cuts during this period of slowing growth. Now, when it comes to sentiment, like I said, it depends. It depends if you're an investor or a trader. So based off of what's happening in the market at the moment, given inflation, given those rate cut expectations, you'd be looking at profiting from a lot of positions, given this noise. However, if you're an investor, you'd most likely be holding on to your position as, bonds, especially gilts, are seen as some sort of a safe haven.
amazing. Amazing, really cool stuff, and obviously we've had a little article on it, and I think there's another one in the works as well on bonds and this sort of topic and discussion. So it'll be interesting to see that go about. Right, Dylan, it's the last topic of the episode for equities, and again, it's another earnings. We've seen this is the issue when we miss out on months. We have a lot of earnings to talk about, so we're going to talk about tech earnings now. So we've had another big round of tech earnings. What were the major takeaways, and are there any companies or themes that really stood out this time around?
Yeah, so a bit later before I go specifically on tech, around 80% of the S&P 500 companies reporting earnings so far for quarter two have beaten analyst estimates.
Wow, that's mad. Yeah,
And the analyst estimates, they're not exactly wrong for having the thought process that they had. But obviously, as I said before, these companies were still waiting to see the impacts of tariffs actually ripple into their earnings, because obviously, the likes of Apple, they imported a lot of their iPhones and their products early on. So, it's going to take a little bit until we see those costs passed on. So, some key highlights here. So, we've got Alphabet, who absolutely smashed their earnings. So they beat revenue consensus by 14%, clocking in at 96 billion. Same with EPS, that rose 22% year on year, and that reached $2.31. And so the market actually dipped at first, and that's because they announced a large capex expenditure, roughly $85 billion. And this is effectively due to investments in AI. So again, as you know, it's been a recurring theme for a long time now. But the
yeah,
companies in the Mag 7, they are really increasing their costs, and it's going to investments in AI. So it's not necessarily a bad thing. Obviously, it's higher cost for the short term, but it might provide a really high return on investment. And obviously boost the stock even further. We saw Microsoft, for example, they reported revenue at $76 billion, and that was up from $73 billion, which was the analyst estimates. And they reported revenue growth of 18% year on year. So it's been good signs for majority of the Mag 7 so far. We're still waiting for a couple earnings to come through. But in terms of the entire S&P, as we say, there's a theme now where they are continuing. These companies are continuing to make revenue, and it maybe is answering the question of, are we in a dot-com bubble, or is there economic output to these investments and in AI? So that's actually sent the S&P to pretty much all-time highs now. We saw the futures market rapidly increase after these earnings. So again, market momentum is high and it's strong. In the UK, for example, we've seen some strong earnings from the likes of Rolls-Royce, and that's because they're slightly more shielded from tariffs. But overall, corporate earnings have been strong this quarter, and it'll be interesting to see whether we're going to see the impacts of tariffs priced in quarter three.
Yeah, no, really interesting stuff. And obviously tech is, as I've kind of alluded to throughout this episode, AI is something that I've got a real passion for. And just to quickly talk about Meta a little bit as well, not talk about their earnings, but to talk about what they've been doing in the AI space. They've been poaching mega employees, mega research strategists from across the pond. And it's pretty cool to see. And they also saw, I mean, completely irrelevant, but there's going to be, so obviously the famous film, The Social Network, there's a part 2, there's a sequel in talks, and it's going to be all about how they, have an impact on presidential campaigns, what they have to do with teens across the world and stuff like that. So to speak, it'd be very interesting to see the impact of that. But I think the Zuckerberg rebrand is pretty much complete. He had a massive rebrand and they smashed earnings, and he's been killing it, and it will be very interesting to see their new AI developments with their new hires as well. Wahy, in the interest of time, we're on to the last topic of the episode. We're going to go on to deal flow and FICC profit trends. We're going to keep this brief, but we're going to delve into it for sure. So how's the pipeline been for FICC related deal flow recently? Has it been a busy summer so far, or has it been a little bit quieter than you might have expected?
Yeah, sure. So just to keep this short and given time, Lloyd's Banking Group delivered a 5% increase in the first half of profits, driven by strong income from mortgages and unsecured consumer lending. And they've also flagged the economic downside risks ahead. Definitely be speaking about this in my next article, so that can be a good read as well. I look forward to speaking about that as well. Lloyd's also reported $2.5 billion in profit after tax in Q2, and they raised their interim dividends by 15% to around 1.22 pence per share. But obviously, Dylan can probably confirm that my equities knowledge isn't as good as his in that regard. So you can definitely look at that. So obviously, when we look at Europe as a whole, investment banks, they've sort of posted their strongest quarterly trading results in a decade. So it's really interesting. Again, I'll be speaking about that in the article too. FICC revenues are surging off the back of this volatility. This is, we're at a time right now where global macro policy leads to a huge change in market sentiment for investors. Again, we're looking at the short term versus investing as a whole. Barclays exemplified the trend in Q2. This means that, given we had a slump in deal making, the trading revenue still jumped 26%. Again, crazy numbers we're talking here. This is driving a 21% rise in investment banking profits as a whole to £1.3 billion. So yeah, we're looking at astonishing numbers here in terms of deal flow and FICC profit as a whole. And yeah, the last point I'm going to mention here is that Goldman Sachs also saw a 22% uplift in trading revenue. So all in all, the team here at FICC have noticed that investment banks deal flow, given global economic uncertainty, geopolitical risks, tensions, and what's been going on with Trump and Powell, those are the most profiting at the moment. We're looking at smart money as a whole. So yeah.
Yeah. You love that smart money, right? I love it. So you love saying it. I'm going to start using it more now as well.
No. I mean, when we need to understand what we're talking about when we mention smart money, we're looking at institutions, high net worth individuals, people that essentially move markets. So the term, given that we work for the smart money, we do coverage. It's really good
for sure. And also the way you've explained that explains our old name, but obviously rebrand. I can't even say the old name, unfortunately, but it explains that old name. But obviously now with Smart Money, we've smartened up, is the way we like to say it. But listen, what a brilliant episode. We really covered a lot, as much as we could, of June and July. And of course, we'll be back for the 1st of September. So thanks, Dylan, thanks, Wahy, for your insights as usual. And we'll see you again in a month. But of course, for our listeners and viewers, we hope you enjoyed that episode and learned as much from it as I did. So if you are watching on YouTube and for some reason you haven't subscribed already, then I'm sure Dylan and Wahy have given you an amazing reason to subscribe and to see more episodes of the Smart Money Show. Of course, our normal episodes with interviews with elite finance professionals within their respective fields. And of course, same goes for those who are listening to us on audio platforms. On both platforms, you can give a like, give a follow, and drop a comment if there's someone we should be speaking to that we haven't spoken to yet, a topic that we should cover that we haven't covered on the show yet, or if you just want to refute some of the opinions that Dylan and Wahy have given on this episode, then I'll gladly welcome them and, give them back to them with a bit more exaggeration potentially as well. But as usual, thank you so much for watching. Do show us some love on our social media platforms. Check out the website for some student-led journalism and reporting, and we'll see you next week for yet another episode of the Smart Money Show. Take care and stay tuned. Thank you.